forms of investment, traditional ideology, into something that we have been talking about that was fringe. And you never heard money managers talk about anything greater than a 5% allocation to precious metals. Now, we always knew that that was underweighted, certainly, but to see the CIO from some of the biggest commercial banks on the planet start to do this tells you that we are moving towards some form of a new understanding, appreciation, or integration of gold and silver into people's portfolios. And quite frankly, if they would have been listening to guys like Alasdair or Rick a long time ago, these moves would have been made years ago when there was still a tremendous amount of upside to be made. Now, not to say there isn't now, but how much of the move has been missed, I guess only time will tell. Actually, I don't think that it's been too much in comparison to where I think it is going. But I think the most important thing to take away from this:
a subtle but substantial reevaluation is underway on Wall Street. Investment officers and chief strategists who considered precious metals peripheral are increasingly quietly changing their models. Andy Schectman, a longtime market participant and dealer in physical metals, explained why more conventional money managers are discussing gold and silver and allocating capital to them in a recent interview. He attributes that development to a more comprehensive reevaluation of portfolio structure, fiat currency risk, and bonds for serious investors. A simple structural issue drives this reappraisal. Bonds no longer offer the same pure yield or protective profile as during inflation and higher real rates. Fixed income is underperforming as a stabilizer in a 60-40 portfolio due to policy uncertainty and an increased central bank balance sheet. This requires investment committees and CIOs to ask tough questions about currency risk, buying power preservation, and the viability of increasing scarce tangible asset allocation in a multi-asset strategy. Andy also highlights tailwinds. Institutional reallocation, large endowments, and bank CIOs' renewed willingness to own non-trivial percentages of precious metals, and a retail base that is more sophisticated and larger in transaction size despite a smaller order count than the squeezes of early 2021. The confluence of these elements creates a demand profile unlike prior rallies. Strategic allocation decisions and structural flows drive it, not speculation. This is important for investors who value portfolio resilience over short-term price changes. If you're interested in strategic precious metals exposure and rigorous market context, like, subscribe, and watch the video until the conclusion to avoid missing any key insights. I appreciate your help and hope you enjoy the video.
But in any case, if you're speaking about change in the interest rate environment, I don't know, I find it very interesting that we see the chief investment officer for Morgan Stanley shift from a 60-40 allocation to a 60-20-20, 60% stock, 20% bond, 20% precious metals. Michael Hartnett, the chief investment officer for one of the investment, or I think he's chief, for Bank of America, just came out with a 25-25-25-25% strategy. Again, you're seeing big money advisors, money managers, or investment officers reallocate their clients' portfolios away from a 40% allocation to U.S. Treasuries. They are pivoting into what would have been unimaginable. As Rick has often said, and I borrowed that statement from him for so long, 0.5% from Joe and Jane Sixpack to the Harvard Endowment Fund, and I caught the last part before I jumped on here where the Harvard Endowment Fund actually did buy some gold and silver. But we are beginning to see, I think, the money managers or the investment officers from these large institutions pivot the way that the central banks seem to have been doing now for at least a year or two, where they have been shedding U.S. Treasuries in favor of gold, which not only has outperformed the U.S. Treasury market. In fact, it's doubled the performance of the 10-year Treasury over the last 25 years. But look at last year, where gold was up north of 40% and the U.S. Treasury 4.5%, or this year, where you have the U.S. Treasury three-quarters of the way through the year, call it up 3%. Yet the dollar's down 11% and gold is up nearly 50%. So we are witnessing a pivot away from traditional forms of investment, traditional ideology, into something that we have been talking about that was fringe. And you never heard money managers talk about anything greater than a 5% allocation to precious metals. Now, we always knew that that was underweighted, certainly, but to see the CIO from some of the biggest commercial banks on the planet start to do this tells you that we are moving towards some form of a new understanding, appreciation, or integration of gold and silver into people's portfolios. And quite frankly, if they would have been listening to guys like Alasdair or Rick a long time ago, these moves would have been made years ago when there was still a tremendous amount of upside to be made. Now, not to say there isn't now, but how much of the move has been missed, I guess only time will tell. Actually, I don't think that it's been too much in comparison to where I think it is going. But I think the most important thing to take away from this is that you're seeing some of the biggest and influential institutions here in the United States rethink their investment ideology. It's an interesting time, and I hope the general public catches on before it's too late, because I can tell you on the retail side of things, we've seen very sophisticated big money jump in with both feet over the last month or so. Business has been extraordinary. It hasn't been what it was like in 2021, January, February, silver squeeze, where we were getting 500 orders a day. Now we're getting more like maybe 100 or 150, but the size is much greater. The understanding is much greater. The mainstream, they haven't really woken up yet, but there is a subset of people probably listening to Rick and Alasdair and you, Dunnigan, who are waking up. And hopefully it's not too late for the rest of the public. Certainly, I think this is a change that is long overdue. And
we are currently experiencing a reallocation that is not merely anecdotal noise, but rather an institutional movement. When chief investment officers at large firms begin to publicly consider allocations that are significantly higher than the historical single-digit weights to precious metals, and when endowments, allocators, and advisors begin to shift away from long treasury exposure, the outcome is a reorganization of anticipated demand. Those are not micro moves. They are strategic reweightings that alter the base case for future price discovery. Andy introduces a second geopolitically influenced dimension in the subsequent segment, which is interwoven with the reallocation narrative. Institutional flows and portfolio rotations are significant, but so are modifications to the infrastructure of global settlement systems that facilitate the pricing, settlement, and holding of balances denominated in gold or gold-convertible instruments by non-Western economic blocs. Demand becomes not only an investment decision, but also a strategic reserve and transactional choice if payment rails and multi-jurisdictional vaulting establish a practicable pathway for market participants and central banks to settle or denominate in metal rather than a single fiat currency. In summary, the subsequent segment transitions from portfolio theory to the mechanics of how that demand could be realized at scale.
Number one would be the cross-border payment system, the renminbi cross-border payment system that was the mBridge. And this system, which is operational, has already been connected to 11 countries in Southeast Asia, which in and of themselves have twice the population of the United States, about 800 million people. And they also have taken over as China's largest trading partner by far. They represent almost 40% of global GDP. They've also connected several Middle Eastern countries, 5 or 6 of them, into this system. And I think when you take a look at the moves that they are making, it is the development of multi-jurisdictional vaults throughout what ultimately, I believe, will be the Belt Road Initiative. The first vault is completed in Hong Kong. The Shanghai Metals Exchange is expanding their reach. The first one is done in Hong Kong. And what it basically means now is that digital yuan is immediately convertible into gold in the Shanghai Exchange in Hong Kong, if you'd like, for delivery without having to convert first back to US dollars. Now, the second exchange, ironically, is being built in Saudi Arabia. Now, if you go back to the genesis of the mBridge platform, Saudi Arabia was the 5th participant, full participant in mBridge. They are now building one inside of Saudi Arabia. Now, I listened to an interview with the gentleman who developed BRICS Pay, which is the cross-border payment system, B2B, business to business, retail, in essence, small bank to small bank, or business to the public. It's like a credit card, in essence, that will connect any of the folks who use the BRICS Pay system. Now, we have to understand that maybe the biggest move in all of this, that a lot of the naysayers would say the BRICS aren't big enough, they're not substantial enough. And I understand people why they would say that. Independent of their size as is, which represents, I don't know, close to 50% of global GDP. But when Sergei Lavrov, the Russian foreign minister, came out and said, we're opening this up to everyone except the West, except the dollar, the pound, and the European Union, the bells went off, and they should for everyone. And so the gentleman who is setting up BRICS Pay, the developer, said, yes, we are in the process of right now rolling this along with BRICS Bridge, which is central bank to central bank. These are being opened up and rolled out through the Belt Road Initiative right now. That's 75% of human population. And then you throw in the other institutions like the Shanghai Cooperation Organization and the Eurasian Economic Union, along with the BRICS. These are all very closely tied entities. They're not all part of BRICS, but they will all be able to settle on this cross-border payment system that settles in 7 seconds, free from SWIFT interference at a 98% reduction in fees. But the kicker to it all is that, yes, they all would use their own cross-border payment central bank currencies, the digital currencies, that the majority of the countries in the world are already developing or have developed. The key is that they will be able to settle imbalances in gold, and ultimately, through a series of multi-jurisdictional vaults that started in Hong Kong, is now being built in Saudi Arabia, and then through the rest of the Belt Road, so that they can settle imbalances in gold or completely settle in gold. I think it is a trend that is growing with legitimacy by the day, and I think to underestimate it is a mistake. I think that that's kind of what they're counting on. I guess we'll see how it all plays out. This is not a common currency. This is a common settlement currency, with gold replacing not the dollar, but really what stands behind the dollar, the trust that we've lost. You add into it the BRICS Pay layer, which is the B2B side, where anyone who possesses this technology will be able to use it to conduct business. And the fact that it's being rolled out to 75% of human population, the fact that the only institutions, the only countries that will not be able to use it are those within the European Union, the UK, or the United States. All of this settlement outside the dollar, whether it be on central bank side or on the B2B side, on the retail side, is chipping away little by little at the dollar hegemony. And then when you add into it the ability to purchase gold instead of U.S. treasuries, as has been the status quo forever, this chips away at the reserve status. And why would anyone want to own our treasuries with our fiscal irresponsibility, $2 trillion deficits every single year, and the weaponization of the treasury market, the ability to sanction? And President Trump, God bless him for doing what he's trying to do, but you know, when you say to the BRICS countries, if you do this, you unite, we're going to add 150% tariff. That is not a tariff. That is a sanction. This is what is pushing all of these countries together. And I guess, to me, the stroke of genius in all of this is not just making it proprietary to the BRICS countries, but opening it up through a series of treaties, if you will, through all of these countries who are in some way or fashion tied to the BRICS countries. And that, to me, is the key to, I think, this becoming an idea that has merit to one that is wholly legitimate over time.
One of the most significant practical implications of Andy's analysis is that this is a multi-vector shift. It is not merely a small number of allocators who are discretely purchasing. The convergence of portfolio reallocation, modifications to payments infrastructure, and a reassessment of the definition of safe or reserve in a multipolar world is the cause. This is significant to investors because it transforms what could have been a sentiment-driven surge into a structural tightening of the supply-demand equation. The margin for upside surprise increases when the demand side encompasses both traditional allocators repositioning portfolios and sovereign or quasi-sovereign entities constructing operational rails to hold or settle in metal. This effect is further exacerbated by the existence of tangible constraints on the supply side. Mine production is capital-intensive and responds slowly to price signals. Years of permitting, funding, and development are required for the implementation of substantial new initiatives. Some supply is provided by recycling, but it is restricted by logistics and price. And the concentration of high-quality resources in a small number of jurisdictions introduces operational and geopolitical risk. This implies that the market will be obligated to account for the scarcity over extended periods rather than solely in intermittent rallies if demand becomes more predictable and structural. The market structure of silver renders it particularly susceptible to this dynamic, necessitating a dedicated paragraph. Silver serves as both an industrial commodity and a monetary metal. Therefore, it has a dual demand profile. Amplified upward pressure is generated by any increase in industrial demand from electronics, solar, or other technologies, in conjunction with an investment revaluation of precious metals. Additionally, the dollar value of silver's above-ground inventories is significantly lower than that of gold. Consequently, comparable flows can generate greater percentage fluctuations. Silver can therefore provide asymmetric reward potential for investors who comprehend liquidity risk and volatility. However, it also necessitates prudent sizing and perseverance. The long-term expected return profile for physical gold and silver will be significantly different from that of the previous decade if the institutional flows and settlement changes that Andy describes continue to acquire traction. This is the fundamental argument for the bullish position. If this analysis has facilitated your understanding of Andy Schectman's comments in a practical portfolio context, please consider liking the video and subscribing for additional in-depth perspectives that integrate macro, structural, and market mechanics approaches. Please leave a comment with your perspective on allocation sizing, whether it be conservative, tactical, or strategic. I will respond with additional content that delves into the details of execution choices and position sizing. I appreciate your attention. I will see you in the subsequent video.